Well, once again, good morning and welcome to the weekly life insurance webinar. Our intention here at Messer Financial out of Charlotte, North Carolina, to assist the agents with the knowledge of products and sweet spots with certain carriers so that you in turn can go out with confidence, speak to your clients, and assist them in their life insurance needs. Again, this is Mark Conter, and a couple of housekeeping issues for us this morning before we get started. Please be sure to mute your phone. You are on mute, but sometimes something does slip through. So if you begin to hear some background noises that sound like it could be from your home, please be sure to mute that phone. You'll also notice in the right column a place for questions. I'm going to ask this morning that you type your questions in during the presentation, and we'll come back and address all of those questions at the end. And again, we'll ask that you stay with us until the very end so that you can find out the incentive that's being offered with your sale of a product that we'll be presenting today. And today we do have Brian Kowalski, the Regional Director of Life Sales with MassMutual, to present to us the benefits of whole life insurance. Good morning, Brian.
Good morning. How are you?
We're great, man. Thanks.
Good, good. Well, hey, I appreciate it, Mark, so thank you very much. Good morning, everybody. Hope everyone is doing well. As Mark said, my name is Brian Kowalski. I'm a Director of Life Sales for MassMutual. I'm coming from you guys from Raleigh, North Carolina today. I'm on the road in a hotel room, so I'm hoping everything comes through clearly on my cell phone. On the screen in front of you, if you guys can see that, hopefully you guys can see Joe Miller, who's the relationship manager with you guys, and just want to take note of his cell phone, or his office number. So if you guys have any product questions or looking for illustrations or looking for marketing pieces, he's the person to go to. So just want to make sure you guys have his direct information. So with that being said, I'm going to kind of jump into this. So my goal today is not to really talk about products specifically, but more talk general about whole life and the power of whole life. Whole life is such an attractive product to different people at different stages of their life. So to do this, I'll start off with more or less just the basics of whole life. We'll talk about how whole life can do different things at different stages of life. And then I'll go into a piece we call Taming a Bear Market in Retirement. And this is a piece that I'll actually forward on to Mark, and Mark in turn can forward on to you guys. But it's a great piece, and in my opinion, one of the best marketing pieces, really kind of showing the strength of whole life and how whole life can be a great tool, especially in down markets, as kind of a non-correlated asset. So to start with, one of the challenges when we talk about whole life, it is life insurance first and foremost, but when we talk about it, we really try to position it more as an asset. And our biggest challenge is when we talk about life insurance, or we put that word insurance into it, it automatically has that stigmatism of an expense. So one of the challenges we have when we talk about whole life with our clients is really getting them to understand that it's not just another expense like some of their other insurance products may be. It truly has some intrinsic value behind it, and it can do, again, great things at different stages of their life. So what makes whole life different? So first and foremost, it's permanent life insurance. So a lot of clients are probably familiar with term insurance or group insurance. The biggest difference being, again, it's permanent life insurance that they own and that we know is going to be there whenever they need it. All right, there's different guarantees that are associated with it, and I'll go through those individually. With our whole life policy, we're a mutual company, so we do pay participating dividends. So although those dividends aren't guaranteed, we've been around for 165 years. We've never not paid a dividend. And with our huge financial strengths, we don't predict we're not going to pay a dividend in the future. So we obviously have these great dividend opportunities. Being a whole life policy and having the ability to accumulate dividends, we also have cash value accumulation, which again is another important aspect of whole life and sets it apart from some other life insurance products. And then with those advantages come some of the tax advantages that are associated with all types of cash accumulating life insurance products. So whole life, there's basically three primary guarantees. So the first is we have guaranteed premiums. So we have a guaranteed premium amount and a guaranteed premium period. So with MassMutual, we have several different products, but we have a 10-pay that's guaranteed to be paid up in 10 years. We have a 20-pay guaranteed to be paid up in 20 years. We have what we call a Legacy 65, which is guaranteed to be paid up by the age of 65. So that way, if you had let's say a 45-year-old, it'd be paid up in 20 years, or a 55-year-old would be paid up in 10 years, but it gives someone that specific data at age 65 it's paid up. We have another unique product called Hirely Cash Value. It's a little bit of a unique product, and it's a product that I could definitely spend more time on in the future to go over. But what it is, it's a unique whole life product that basically guarantees about 90% of your premiums at the end of year one. So it's specific to business owners especially. So someone who needs to show cash balance on a balance sheet is where that product can be really specific. And then finally, we have what we call our Legacy 100 contract, and that's more like the traditional whole life products that a lot of people are familiar with, where the premiums are scheduled to be paid out all the way out to age 100. Now, it has flexibility in there where we could potentially pay it shorter, just depending on dividends and the way that payments are being paid. But again, that's kind of the traditional whole life product that people know. What's interesting to take note of is up until recently, our number one selling product was our all pay, our Legacy 100 contract. Over the last several years, the transition has changed from those all pay scenarios to these short pay scenarios, so the 10 pay and the 20 pay, and the Legacy 65. And I think what it is people really like the guarantees and the kind of the encouragement of knowing if I pay for this for the next 10 years or 20 years or whatever it may be, that I know with absolute certainty that this will be paid up and that nothing can go wrong with it. So again, we're seeing a lot of changes with those with these short pay scenarios. So with whole life, we also have a guaranteed death benefit. So if I never paid a dividend, which again, historically we've never not paid a dividend, but even if we never paid a dividend, whatever initial death benefit the client chooses is the death benefit that's guaranteed for the entire life. All right? As we do pay dividends, each year the death benefit, if we have paid up additions going into the death benefit, that death benefit will climb, and whatever that death benefit climbs to is now the new guaranteed death benefit. And then in whole life, one of the other underlying values of it is it does have guaranteed cash value. And with guaranteed cash value, again, even if we never paid a dividend, what we do is we guarantee that the policy will endow at age 100. So what that means, in an example, let's say a client has a 10-pay policy, it's $100,000, the premium's $2,000 a year. So at the end of 10 years, they paid in a total of $20,000. What we guarantee is by the time that client reaches age 100, so it's going to compound every year, but by the time the client reaches age 100, there'll actually be $100,000 of cash accumulated in that product. So as I mentioned earlier, dividends are a big part of whole life. So again, although they're not guaranteed, dividends can be very flexible, do a lot of different things in a contract. So a few of the examples are, one, it can reduce out-of-pocket expenses. So as a policy starts accumulating dividends, a client may have had a scheduled premium of X. With these dividends, what they could do is they could reduce that premium of X by whatever that dividend amount is, and in turn potentially have a lower dividend. And many times after we illustrate these, we'll see that, based on a projected dividend rate, maybe 10 years out, 20 years out on an all-pay scenario, you may see that the dividends are actually larger than the premiums do. So at that point, if the client wanted to, they could actually let the dividends pay the premiums and in turn have no more out-of-pocket expenses. Another big thing that dividends do is they increase the death benefit. So if clients don't take the dividends as cash, if they let them go back into the policy, what will happen is if that policy started at $100,000 and accrues dividends year after year, what started at $100,000 can easily grow into $200,000, $300,000 over the lifetime of the contract. And again, it's all the compounding aspects of those dividends. In turn, the dividends gain dividends, and it's a big compounding aspect. The accumulation of cash value, again, that's due to these paid-up additions. And again, it's just one of the features of whole life that, again, makes it unique from other products. But those paid-up additions, again, allow for chunks of paid-up insurance that in turn get those full-blown dividends. And then probably a huge part of having those dividends is down the road, you have clients who think, I may not need as much death benefit later on, but I do need income. So potentially they could use those dividends and just take them as cash. It could be a great way for someone to supplement their income later in life. All right, so I talked about the cash accumulation aspects of whole life. So again, it's guaranteed cash value. So again, at age 100, I guarantee that we're going to endow the policy. We have those dividends. I'm sorry, I went backwards there. All right. I'm sorry, guys. Income tax advantages. I was going the wrong way on my slide here. So there's plenty of income tax advantages that go on with permanent life insurance. So basically, you pay for it with after-tax dollars. All the money in there goes tax deferred. When the client wants to take cash out of the policy, they have the choice of either taking taking a return of their principal, so they can take out their principal, or they can take loans. So if you think about it from an accounting standpoint, if the policy is a non-NEC, it's first in, first out for accounting. So what that means is over the lifetime of the policy, let's say the client puts $20,000 into that life insurance contract. 20 years down the road, they decide they want to take money out of the policy. Well, the first $20,000 they pull out is a return of their principal. So that comes back to them tax-free as just a return of principal. At that point, let's say there's $60,000 of cash in the policy. After they took out their principal, if they want to take out additional money, what they can do is they can take loans off the contract. And the advantage of taking loans versus withdrawals after you've taken out your basis is it doesn't generate a 1099, so in turn the client can take out tax-free income. All right? And then at death, the client receives that death benefit income tax-free. So MassMutual, what we believe is a whole life policy can be a versatile financial asset that can do different things for your client at different stages of life. And what I want to do is kind of go through that in more detail and point out some of those benefits. So with life insurance, we have a lot of people that are believers in term insurance alone. And the idea is, I only need term insurance for the next 20 years. Or I only need term insurance until my kids are out of college. Or I only need term insurance until I retire. Or I only need term insurance until my house is paid off. So the way I look at it is this. Is term insurance is an important way of getting the biggest bang for your buck, especially for younger clients that have obligations, have people that rely on them. So it's the best way to get the biggest bang for your buck as far as getting the insurance need taken care of. But the challenge with term insurance is it's not permanent. It's not going to last forever. So what we always look at typically is kind of blending in term insurance and whole life insurance. And the idea is, the argument is, you actually may need insurance later in life. And what I want to do is kind of go through what life insurance can do at different stages of life, which in turn can help you with that. So protect their value as a provider. So first and foremost, it is life insurance. Cash or credit during times of need. So it's a great place to go in for emergency money. It's an important part of someone's retirement strategy. It can be a great way to supplement long-term care, and I'll talk about that in a moment as far as a long-term care rider. And then ultimately have that death benefit that may benefit your living spouse or be passed on to your beneficiaries. So again, protecting their value as a provider. So first and foremost aspect of life insurance is it's there to basically protect the value of the provider. So if you have someone who relies on you financially and you care to make sure they're taken care of, if you weren't there to provide for them, life insurance is going to be an important part of their overall financial strength, right? But what's interesting is you look at households in America, trends have changed. And what we're seeing here is, if you go back to the 1960s, about 83% of households own some sort of individual life insurance. All right, over the years, the trends have kind of come down where people aren't owning individual life insurance as much. And I believe what it is, it's really the benefits of companies. So companies, if someone's working for a good employer, those employers are going in and talking about the benefits of working for them, giving them benefit packages, and in turn, the client now receiving group insurance maybe thinks that group insurance is going to fill all their needs. So one of the things that I think is interesting about group insurance is this. Is statistically, and this comes from Limmer, but statistically, there's two ways that people typically choose how much group insurance they purchase. So if you think of a typical company, and I'm kind of using myself as an example, at MassMutual, the way they offer our group insurance is they'll give me 1 times my income for free, and they'll give me up to 5 times my income with no underwriting. All right? So if I was able to ask you guys a question and get a response, I would ask, what do you guys think is the most common way people determine how much group insurance they need? The answer is whatever's free. So the majority of times when clients have access to a group benefit plan, they're going to choose whatever the company's going to give them for free. All right? The second most common way people are going to determine how much group insurance they need is whatever doesn't require any underwriting. All right? So my example, they'll give me 5 times my income, no underwriting. All right? Now, the challenge we sometimes have is to some clients, they may look at that and think 5 times my income, that's a decent amount of money. I think my spouse and my kids will be taken care of if I give them that much money or leave them that much money. And it's our job many times to kind of go in there and make sure they understand that, that's a complete loss of income. You can't generate any more income from that day forward. And it's really getting them to understand that that's probably not enough. And especially if you don't want your spouse to be required to get remarried, or maybe have to go back to work, or have to go do different things that are going to make life a struggle. If you want to stay in the house, if you want to make sure your kids go to college, again, you're going to need to make sure there's more money there to make sure they're completely taken care of. Now, the other thing is if you're not there, not only providing for them currently, you're also not there saving for their future. That's also going to affect your surviving spouse's retirement benefits. So again, the challenge is making sure clients understand how much insurance they need, and then maybe trying to diversify, some of it permanent, some of it term, some of it group insurance. So what we know, this comes from LIMRA, is 30% of U.S. households have no life insurance, period. 26% of households have only group insurance. A third of affluent households say they do not have enough life insurance. And of all the U.S. households together, on average, they have about 3.5 years worth of income replacement in life insurance. All right, so what we do know is that's definitely underinsured. So America is underinsured. And again, it's our job to go in there and talk about different types of insurance and different ways of maybe planning for it. Again, term insurance may be the easiest way to get to that goal, but what we need to do is show them some of the benefits of whole life and permanent insurance and make sure they understand what it can do at different stages of life. All right. So all that last chart shows is, based on the client's age and their income, kind of a rough idea of how much insurance they may want to consider. All right. But again, what we know is when clients start considering that, what they're probably going to do is look at term insurance first and foremost, which no one can blame them for, right? It's going to be the least expensive way to make sure that coverage is taken care of. But again, what we need them to do is understand that term insurance is temporary. And in this chart here, we're just showing an example of a 35-year-old male who buys a 20-year term policy. The premiums are about $270 a year for the first 20 years. And the thing is, under the guaranteed aspect, if the client renews it, this is a MassMutual policy, they renew it, their premiums would jump up to $4,200 a year. All right, so huge jump. And again, it's that client who all of a sudden realizes, now I'm 55 years old, I have a life insurance need, but I bought that 20-year term earlier, which I thought was sufficient. All of a sudden now I'm realizing maybe it's not. So I know I can't hear from you guys, but I'm assuming most of you guys know who Dave Ramsey is, or Susan Orman. So I live in Franklin, Tennessee is where I actually reside. So he's the home of Dave Ramsey. And the question I always ask, and I think it's interesting to kind of get people's feedback, is know what Dave Ramsey says. So his big claim to fame is buy term, invest the difference. All right? And his big claim to fame is really the idea of, people need life insurance. So the good news is he does help encourage life insurance, but all he ever wants to talk about is term insurance. Now, there's a few things that he points out that kind of help us debunk what he's talking about. So if you ever read his book, so he has a book called Financial Peace University. Again, he lives in Franklin, Tennessee. He always talks about, again, you need life insurance. So if you have someone who's relying on you, you need to go out and get it. He talks about buying 20 to 30 times your income. All right. So the good news is he's helping promote term insurance. So if you have a client who is a Dave Ramsey follower, has a big belief in Dave Ramsey, go ahead and offer them the term insurance. And you know what? Since he tries to encourage people to get so much, make sure they have 20 to 30 times their amount in term insurance. Once I have them in term insurance, I could always talk about converting them later, because once I have them locked in, now I can start talking about permanent insurance and why it makes more sense to them. All right, but one of the things I always kind of laugh about is, so Dave Ramsey, he always kind of talks about in his book, like living simple and living like no one else so you can live like someone else. And what that means is just living well below your means. And he talks about, even if you have the money to go out and buy a new Lexus, what you should really do is go out and buy that used Honda Accord, right? And if you have a house, don't buy a huge house, buy a small house. But again, it's all about stockpiling money, all right? But he just kind of talks about, if you have this money, you can do different things at different stages of your life. But what's funny is when I ask people, would you think Dave Ramsey, would you think he'd be a very big show-off with his money, or do you think he'd be under the radar? I'll get mixed responses, but a lot of people will tell me they think he'd probably be kind of low-key, just kind of based on the way he preaches of what he does. It's the furthest thing from the truth. So me living in Franklin, Tennessee, that's like rock star central. Anyone who's anyone, the rock star, the country business, the music business, they all have houses in that general area. And no doubt, Dave Ramsey probably has the biggest house in town. It's built on top of a hill that overlooks everything, so it's got great views. I have no doubt he paid cash for it, so he always talks about paying cash for things. And the thing is, he's got net worth, but he's not a conservative type person. He has this huge house. If he's home, it's lit up like a Christmas tree. He's got spotlights on it. He drives very, very exotic cars, so he's got an incredible exotic car collection. We actually saw his house when it was getting built, and I can't remember if it was a 5 or 6 bay garage. Well, one of the bays is actually a ramp that goes down into the basement, so you can have additional car storage, right? So he's got this elaborate lifestyle, right? So one of the things I always talk about is, he kind of preaches about how to live simple, but many times he's not talking to your clients, right? If you have a client who's living paycheck to paycheck and barely scraping by, he has a lot of great stuff to say. But if you have a client who's got some decent net worth, isn't living paycheck to paycheck, is concerned about saving and being conservative, again, he's not talking to them. These people are already kind of, self-sufficient and are doing what they need to do. Now we can show them some other creative things. Now, when Dave Ramsey talks about buy term, invest the difference, in his book, what he used to claim is a good mutual fund will do 14% a year. All right. I don't know if I'm hearing any awes on there because I can't hear you guys, but I don't know about you, but if I'm supposed to have gotten 14% a year for the last 15 years, I need to fire my broker because I sure as heck haven't come anywhere close to that. All right. He's since then changed his tone to a good mutual fund will do anywhere from 10 to 12% a year, so he's come down a little bit. Now, I don't doubt over the long run mutual funds could do that 10%. And if we go back and look at the S&P 500 from the 1930s to today, it actually has averaged right around 10%. The 10% can be a more realistic number. But what he's not taking into account or talking about as well is he does say you should have a financial advisor. And if you have a financial advisor, your advisor is probably not going to tell you to take all your money and dump it in stocks or equities. Right? That advisor is going to tell you need to diversify to some extent. And you diversify your portfolio, I'm not expecting to get 10% in that entire portfolio. I'm hoping I can maybe get 10% in my equities over the long run. But if I have fixed assets, I'll be happy if I get 3 or 4%. Right? And what I challenge him to is, buy term, invest the difference. Well, again, if I'm going to buy term and invest the difference, part of that difference is going to be in something conservative. And what I want people to look at is, for that conservative piece of the portfolio, let's look at life insurance. Because depending on the client's age and health, 10 years, 15 years, 20 years into a life insurance, a whole life portfolio, I could see a 5% pre-tax rate of return. Depending on the tax bracket, that could be a tax equivalent of 7 or 8%. And again, if that's my non-correlated asset that's not tied to the markets and that's really safe money that really is guaranteed to have some growth in it, it's not guaranteed to go to that 5%, but under current assumptions in this low interest rate environment, I can show that that's a great place to have my money in that non-correlated asset. And it's life insurance, so it's got leverage, in different directions. So one of the things that Dave Ramsey does talk about is having cash or credit during times of need, right? And what he'll typically say is, everyone should have a reserve fund, right? And it should be about 6 months worth of living expenses. Well, to those clients, what he's telling them to do is keep money in a savings account, right? And I do think it's smart to keep money to the side. I don't necessarily know if keeping in a savings account is the best place to keep it. But one of the nice things about whole life is you have access to that cash. So once you accumulate cash in there, it's very easy to get to. And although you can't write a check right off of the policy, you can easily get a check in your hand or get a wire deposit into your account within 3 or 4 business days. So if you need money in an emergency situation, pulling money from your whole life policy could be a great place to get it. And more importantly, instead of having it sit stagnant in a savings account or checking account that's doing nothing, it could be potentially in this whole life policy that, again, may be getting 2, 3, 4% in those earlier years. All right. Some statistics we have: back in 1929, J.C. Penney borrowed money from his whole life policy to help make the company's payroll. So obviously, J.C. Penney's is still around, so that was a good move on his part. Walt Disney, back in the 1950s, used his whole life policy to help fund his theme park. So just kind of 2 examples of well-known people who had whole life policies and use the benefits of the ability to get cash out of those policies and use the leverage of it. All right, whole life can also be an important part of someone's retirement strategy. So hopefully, if we're meeting with our clients or sitting with our clients, especially the younger clients that have some time horizon in front of them, the idea is we need to be saving. All right, we need to be putting money away, and whole life can be an incredible place to again accumulate money. So it's a great place for supplemental retirement income. It's also a great place to have money for the fact that it's not correlated to the markets. So the markets go down, there's no negative effect on your whole life policy. Your whole life policy will continue to do what it's doing. All right. And more importantly, even if I need money, it's not in a qualified plan. So if I need to get the money quicker, there's no 10% early withdrawal fees. Or for the fact that it's not a qualified plan, maybe I accumulate enough money later in life and I don't even need to take those distributions from there. So I'm not going to have those RMD requirements. So again, it gives your client a little more flexibility and does different things at different stages of life. So what concerns today's retirees? So obviously probably a big thing is just making sure they don't outlive their money. So not saving enough is going to be a big thing. The impact of market volatility. All right, the future of Social Security or Medicare, not really knowing what's going to happen. The cost of healthcare and long-term care. And then maybe you have a client who says, my biggest concern is making sure I leave a legacy to my family. All right. Well, one of the things we know is the more you earn, the more discriminated you are against. So let me say it again. So the more money you earn, the more discrimination you have against you as far as what you can do with your money and grow it in a tax-favored way. So just as an example, what this chart here kind of shows is if I have a client who has a $50,000 annual income, their Social Security benefit could potentially make up about 40% of that shortfall in retirement. All right? If I have someone making $250,000, that Social Security benefit may only make up about 12% of their shortfall. So that $250,000 income earner has a lot more downfall risk and basically has more money to invest and needs other places to put it. Now, another way to think about that is even 401ks. So 401k, someone can contribute without catch-up provisions, can contribute up to $18,000 a year into a 401k. So if I have a client who makes $100,000 a year, I could literally put 18% of my income into a 401k. If you have a client who makes $1 million a year, and I know I'm using extreme numbers here, but just to kind of make the point, if I have a client who makes $1 million a year, they can still only put $18,000 a year into that 401k, which is 1.8% of their income versus the 18% of that $100,000 income. So again, the more you make, the more discrimination you have as far as these tax-favored vehicles or places you can go. And one of the great things about whole life or permanent life insurance is the fact you pay for it again with after-tax dollars. It grows tax-deferred. You can pull it out tax-free, but you can contribute as much as you like. So as long as you can financially qualify for it and you have the means to fund it, you can put as much or as little as you'd like into those life insurance policies and build your own tax-deferred, tax-favored vehicle. So the other thing that people think about when they talk about retirement savings is having a systematic way to set aside funds. So with whole life, I can pay for it monthly. So monthly I can set aside funds to help accumulate money in this product. They like that tax-deferred growth of cash value, and then obviously the tax-free income you can pull out of it. So investing 101. Investing 101 is buy low, sell high. All right? Now here's the challenge. What if you have all your money in equities and the markets tank on you and you need to take distributions from those equities to live off of in retirement? All right? If that's the case, you really can't live by that buy low, sell high investment strategy, right? Because you're kind of out of control because it's not in your control. All right? So what I want to do is kind of talk about whole life and show you one of the huge benefits of whole life and what it can do for a client who, again, has the means to fund it, sees the value of that life insurance, and what that can do for them in those down markets. Now, one of the things I want to kind of just stress right at the beginning is I'm going to go through a marketing piece that MassMutual has. We call it Taming the Bear Market in Retirement. And I'm going to use some bigger numbers, and it's just the way this presentation is set up. So I'm going to use a client who has a $2 million retirement portfolio at age 65. As I go through this, just be aware that you can take these numbers and scale them down. So if that number just seems too big or doesn't seem like your potential client, don't worry about it. We have the same piece, the only difference being it tells the same story, the only difference being instead of this client at age 65 having a $2 million retirement portfolio, the client has a $500,000 retirement portfolio. So now we're kind of bringing it back to more of our middle America clients, right? But again, the same strategy works, the same story works, and what I need you guys to do more importantly is just kind of focus on the story so you can get an understanding of how this works and why this is so impactful. All right, so in this story, I have an executive. His name's Robert. All right, he's a high-income earner. Again, he's one of these guys who, regardless of what his income is, he has the means to fund additional money into a whole life policy. He sees the value of whole life. He has a family. He has kids, right? So when he's 45 years old, he takes out a $1 million whole life policy. Right? It's a 20 pay, so it's guaranteed to be paid up in 20 years. Now, again, he's got the means to do this. His premium in that policy is about $28,000 a year. All right? But you understand there's a lot of flexibility with that premium, and again, this policy is going to do different things at different stages of life. If I use the other brochure we have, basically cut those numbers down, I think it's about a $7,000 premium. So the one that I'll make sure Mark forwards to you, you'll have two versions, but there's also that smaller version, again, telling the same story. All right, but if I stick to Robert's story, so he's got $2 million in pre-tax IRA assets. All right, again, when he was 45 years old, he funded a whole life policy that was paid up by the time he was 65. So I'm fast forwarding 20 years, so he's had that whole life policy for 20 years now. It's paid up. He's now ready to retire. All right, in his equities, his retirement, his qualified plan, he's got $2 million of equities, so they're all invested in the equity markets. All right, what he figures is he needs about $100,000 a year to live off of. He's in a 35% tax bracket, 33% tax bracket. So for the fact that nothing's been taxed yet, he'd have to take a withdrawal of $150,000 each year so he can net that $100,000 after taxes. Right? But what we're going to do in this particular example is we're going to strategically choose where he pulls the money. So we're going to look at the stock market. So we're going to look at the S&P from 1973 to 1987. So we're going to carve out a 15-year window of the S&P. All right. Now, what I need you guys to keep in mind is over the long run, the S&P has truly averaged right around 10%. All right. Now, we're specifically picking this 15-year period. The reason why is because in the first 2 years, the stock market had a big correction. All right. So timing's everything. So the sequence of returns has a huge impact on how someone's portfolio does. But what's interesting is in that 15-year window, even though we had, in the beginning, we had 2 big down years, which I'll show you in detail, it actually averaged 11.28% over that 15-year window. All right. So when clients kind of talk about averages, it's great that you can average whatever rate of return you want in your portfolio. But the point is, strategically, you got to decide when you pull those distributions, where you pull them from. And if you pull distributions from something that's been down by the market, you're only causing a bigger wound because you're pulling more out of something that's already been down, right? In turn, you have a bigger impact, a negative impact on those investments. So again, we're looking at the S&P from 1973 to 1987. The average 11.28%. In that 15-year window, the market was only down 4 times, right? But what we're going to do is we're going to look at 2 different distribution strategies. So the first distribution strategy is Robert, every January 1st, without taking any regard to what the markets did the year prior, he's just going to automatically, January 1st, pull $150,000 out of his equities, all right, pay the taxes, which is going to net him $100,000. He's going to let the money ride, all right? So just year after year for the next 15 years, he's just going to do that on autopilot. What scenario number 2 is every January 1st, he's still going to take $150,000, or he's going to take his distribution, which is going to equal $150,000 or $100,000 after taxes, all right? But what he's going to do is any year following a down year in his portfolio, he's not going to take the money from his equities, which again have already been crushed by the market. What he's going to do is he's going to take his distribution from his whole life policy that's been sitting idle on the side. Again, so he funded this policy 20 years ago, all right, over the last 20 years. He sees the benefit of the life insurance, so he knows he wants the life insurance, but he understands that he has the ability to go in and take distributions from it whenever he needs to, tax-free. So in turn, any year following a down year, he's going to pull $100,000 from his life insurance policy because it comes out tax-free versus $150,000 he'd have to pull from his equities and pay the taxes on. All right. And what I want to do is just kind of look at these 2 side by side and show you the impact of how strategically choosing where and how you pull your money can ultimately affect the way your portfolio ends up. So hopefully you guys can see this pretty clearly. So at age 65, I'm showing he's got $2 million. All right. So January 1st, he pulls out his $150,000. It leaves him $1,850,000. All right. The S&P is down 14.8% that year. So here he is. He's 1 year in retirement. He's got $1,576,000 remaining. Right? I carry that number over to the second line now. So age 66, he starts off with $1,576,000, pulls his $150,000 out again. That leaves him $1,426,000. The market's down 26% that year. So here he is. He's 2 years in retirement. He's down to almost $1 million. All right, what do you guys think he's thinking now? Even more importantly, how many clients, and I'm not sure what all, I know you guys have different various backgrounds, but I'm sure some of you have these clients where, man, if they saw their portfolio do that, that's what they're going to say. You know what, cash me out. I'm taking too much risk. I've lost too much money. I can't stomach this anymore. I need out. Well, the good thing is if you're a Robert's advisor, you could tell them, hey, Robert, look, we planned for this. If you remember, we funded a whole life policy earlier on in life, and we have access to pull money from that. So don't sell out your equities right now for the fact they've been down, because the thing is, over history, historically, these things come back. But the thing is, I just can't predict when they're going to come back. But historically, we know they have bounced back, and we predict they're going to bounce back again. So the idea is, on those down years, let's pull money from that whole life policy. But if I go through his scenario here, again, he just does that on autopilot year after year. The good news is he has good years after those bad years. But if we do that on autopilot, at the end of 15 years, he has a $900,000 portfolio balance remaining. All right, so he started with $2 million. He's down to $900,000. Right, but he was definitely sweating it in year 2 when he was down to almost $1 million. And he was only 2 years into retirement. Right. So scenario number 2 is, again, any year following a down year, we're not going to take a distribution from his equities. We're going to pull that money from his whole life policy. All right, and again, that's on the side, so I'm not showing this in the slides, but just knowing that he had that as an availability to him. So year one's exactly the same. I can't predict what the market's going to do in the year, so year one's exactly the same. All right. In year two, for the fact that the market was down the prior year, so the market was down 14.8% the prior year. So in year two, he's not going to take his distribution from his variable accounts. He's going to pull it from his life insurance policy, like we said, and that pulls over his balance, right? Because the market was down again that year, again, we don't take a distribution from our variable accounts. We pull from our whole life, so on and so forth. So if you look down this channel here, you can see the market was down 4 times. So there's 4 times he wouldn't be taking full distributions from the adjustable variable account. Now, the one thing I want to point out is at age 74, what you guys will notice is he still took a distribution of $77,000 in this story. Well, the reason for that was what MassMutual was assuming from a compliance standpoint was all of his qualified money was in this account, and he had RMDs. So even though the market was down at age 73, because of his RMDs, he still had to take his minimum RMD. So it's almost as if he skipped 3.5 years worth of distributions. But by skipping those 3.5 years, and again, not compounding the wound of the down markets and pulling more money out of it, it's leaving a balance of $3.3 million versus that $900,000. So we look at this side by side. How impactful is that? So as being someone's trusted advisor or selling them whole life and showing them the benefits of whole life, you can use it for retirement supplement, but more importantly, instead of taking like a fixed stream of income, what if we strategically choose when we pull money out of it, and any years following a down year in the market, that's where we're going to pull money out of our whole life policy. If the markets are doing well, we'll pull money out of the market. All right? And again, it just helps you balance it, but that's the diversification of assets, and that's allowing the client, again, to strategically choose when and how they pull money. And meanwhile, they're pulling from a whole life policy that they always needed the life insurance in the earlier years, had access to that cash anytime they needed it, and now it's just part of that retirement strategy. All right. Now, what about long-term care? So I know I told my mark there's a lot of Medicaid, Medicare, a lot of planning for clients with long-term care type needs. Well, one of the features or one of the riders we have in our whole life products, we call it our long-term care access rider. All right, and it's a rider you can put onto a policy at issue. And what the rider does is it allows the client to accelerate. Now tied into our life insurance policy. All right. Now, where this becomes really attractive is when we think about long-term care sales in the industry, there's a few things to keep in mind. One is we're not selling nearly as much long-term care as we used to. Right? And one of the biggest reasons for it is the cost has gone up. Right? So with MassMutual, we do have standalone long-term care products. All right? We still sell them. They're still on the market. We've seen a lot of carriers get out of it completely. All right? But the reason why carriers being longer, they're putting a bigger strain on long-term care as a whole. So with MassMutual as an example, we've been selling long-term care for years. We used to sell a lot more of it when we had lower prices on it. We've never gone in and increased an existing clients or existing policyholders' cost. So we've kept every policy as it was sold, right? But what we have done is on new policies, the cost has gone up. So if you were to buy a policy today versus buying it 5 years ago, the cost today is going to be more expensive. Again, it's because we have a bigger realization of that risk of long-term care and knowing that as people are living longer, they're not going to live better, and in turn, we're going to have more people looking for long-term care. And that's what's really triggered MassMutual to kind of look at these other types of alternatives for long-term care, one of them being on our whole life product. And if you think about it, on whole life, because it's permanent life insurance, we know we're paying out that death claim. We've already built into that product that we're going to pay out that death claim one way or the other. All right? But to that client, what it's allowing them to do is now accelerate that death benefit while they're living for long-term care purposes. So it's not based on being terminally ill, because we have that on our products as well, where the client's going to die within the next 2 years. Right? With long-term care, you may have 10 years, 20 years worth of life ahead of you. And the idea is if you're not terminally ill, you're not going to be able to accelerate your death benefit for the terminal illness aspect of it. But if you do qualify for long-term care, we can at least let you start taking some of your death benefit while you're living tax-free for long-term care purposes. Now, where this also becomes very attractive is, on a whole life policy, the typical client is probably going to be on the younger side. And when I say younger, it's probably going to be the client who's probably between the ages of like 35 and 55. All right. Now, it goes younger than that and it goes higher than that. But the reason why I'm kind of using that window there is because, at age 35 is when clients really start getting their legs under them. All right. People are starting to get established. They've already bought their house. They may or may not have kids, but they're just kind of, their jobs are doing better and they have more money to spend. So in turn, they can start looking at permanent insurance versus maybe just that term insurance. On the higher side, when I'm saying 55, on the higher side, because whole life is a cash accumulating product, you still need time ahead of you to accumulate cash in an attractive manner. And the younger you are and start the policy, the better it's going to look in the future, right? And again, you can go over age 55, but if I'm just trying to pick the sweet spots, we typically see probably about 55 is within that sweet spot. Well, as I talk about those clients, they're great components for whole life, but they may not be the best prospects for long-term care, because we probably see long-term care being offered more in your 60s. Right? I don't know if you guys would agree with that, if you could answer me. But we typically see long-term care kind of starting in their 60s. Well, the way that this long-term care access rider would work is this. Look, if you've already committed to buying whole life, you understand all the living benefits of whole life, you know the flexibility of it, you know it can do different things at different stages of life. Well, long-term care is definitely a big piece of your overall financial plan we have to talk about. But again, at age 35 or age 40, you may not be in a position to buy a standalone long-term care policy and whole life at the same time, because they're two different things, right? Now, they can view the whole life as an asset, but they may view that long-term care as an expense, all right? So the idea is for a little bit of additional premium, so the cost of that rider is anywhere from like 2 to 3% of the total premium, which is about the same cost of waiver premium. Now, waiver premium probably goes on about 95% of our policies if they're eligible for it. All right, so the long-term care access rider, again, is almost like selling waiver premium on a policy. It's a little bit more money, but it's minimal. But the idea is now I have something that looks and smells like long-term care, and if you need it, that's going to be the best little bit of money you spend. If you don't ever use it, you know what? It really didn't cost you much in the first place, so it's not as big of an impact of if I buy standalone long-term care, pay years and years of premium, never use it, that's going to be kind of a detriment to someone's portfolio, right? But in here, it's a minimal cost. If I need it, it's there. If I don't, no big deal. Well, the other thing this allows us to do, if I'm talking to that 40-year-old as an example, is now I'm getting the long-term care conversation teed up, right? And I'll tell you what, if long-term care still exists for sale when you're 60 years old, we'll talk about it. My concern is I don't know if standalone long-term care is going to still exist for sale in the industry when that client's 20 years older, right? I don't know if you guys would agree or disagree with that, but we know that carriers are dropping out left and right. We know the costs are going way up, and what's happening is we're seeing more of these hybrid products. Again, this whole life policy could be one of those hybrid products. All right, what about ensuring your legacy for the future? So kind of the last part of whole life is the idea of, again, it's still permanent life insurance, but many clients, again, believe that they only need it for 20 years or until they're 65 or until their house is paid off. And again, what I want to do is challenge them to the fact of, death benefit can be used at different stages of life for different things. But a big part of it could be your post-retirement life insurance. Right? And if you think about it, if you have a husband and wife, you both have equal benefits. So let's say they both have the same Social Security benefit, the same pension benefit, and have an annuity benefit. If I took that, combine them together, they have X amount of income they're going to live off of. So spouse A and spouse B have equal Social Security, so a benefit of $2,500 each, a pension and annuity income of $3,000 and $2,000 respectively that are joint with 50% survivorship. Well, what happens when spouse A dies? All right, when spouse A dies, spouse B is going to lose their Social Security benefit, right? And we know that pension benefit is going to be cut in half. So to kind of put this in perspective, when both husband and wife are living, maybe they have a $10,000 $10,000 monthly income they can live off of, right? All of a sudden, one of the two passes away based on that example I just showed. All of a sudden now they have a $5,000 income, right? So the surviving spouse, that surviving spouse's income got cut in half, right? But just because I lose a spouse doesn't mean my expenses are cut in half, right? Like if I pass away, my wife's expenses may go down 10% in total, but definitely not going to cut in half 50%, right? So the idea is if I had that permanent life insurance that I bought X amount of years earlier and that death benefit's there to pay out now, think of how much more easy that lifestyle is going to be for that surviving spouse when they have a big chunk of money now that comes into their portfolio. In turn, they can do whatever they want with and help supplement the loss of their husband or spouse's benefits. All right? And then, leaving a legacy. If you think about someone's portfolio, the most important or the biggest aspect of whole life insurance is still the life insurance part of it. All right? And if you have clients that don't plan on dying with $0 for their name, so if you have clients that have done some good planning, all right, have some assets in place, and can pretty much look you in the face and say, look, I've taken care of all the risks in my portfolio, and I'm pretty confident when I pass away, I'm going to have money left over. And if I can leverage that money and leave more to my kids, I'd like to do it. Well, life insurance is the best product to have left standing in your portfolio when it comes to death. Right? And the biggest reason for it is, the death benefit's going to be paid income tax free. That death benefit can be there immediately to pay expenses, to pay for funeral expenses, to pay taxes. It's easily divisible among family members. All right, it bypasses probate, so it's set beneficiaries, so it goes right to those beneficiaries. And again, there's no market fluctuation with it. So if someone bought that guaranteed $250,000 life insurance policy, 40 years earlier, again, I'm guaranteed at the very least, if I never hit a dividend, it's still worth $250. But in reality, with those dividends, that policy could be worth like $700,000. Maybe they pulled money out of it over the years, so maybe it's down to $400,000. But again, it's still a death benefit that's there and it's permanent, and it's giving them that benefit of later protection. So in summary, I believe if you can explain and understand how whole life works and show it to your clients, I believe that you can sell more whole life insurance. All right. Any questions? Mark, are you able to open up the lines by chance? Or if you got any email questions, can you tell me what some of the emails were?
Hey, Brian, thank you very much. Unfortunately,
you're very welcome. Okay, good. I was making sure.
Yeah.
I heard that silence there for a minute. I was like, oh man, what if I got disconnected like 30 minutes ago and didn't realize it?
No, you didn't, but we had that problem here locally, and a couple of our people in the audience did as well. Before I get into the actual questions that are there, I want to first of all say thank you for going through a presentation of information not sensitive to the company products, but really helping agents understand the value of whole life insurance. I think the presentation, you've put forward here, which, ladies and gentlemen, this is being recorded. It should be up on our Learning Center within the next 24 hours. You'll be able to go back to this because I know there was a lot of information there, and probably some things you couldn't even take them down as fast as the ideas were coming at you. Which again, Brian, excellent information. And thank you.
Good, thank you.
When we're looking at a company like MassMutual, ladies and gentlemen, it's very important for you to understand the benefits of your relationship with us here at Messer Financial. Unless you became captive, your ability to sell products of this quality would not be available to you. Now, normally on these webinars, I make you aware of going to our website for the contracting. However, it's a little different with our relationship here. The biggest difference that you need to understand is in order for me to get you the link for contracting to the company, you're going to have to bring in a piece of business. So what that means is you're going to have to rely on us here, and there's many of us here now working on the agent support side to help you get the information you need, number one, help you get the illustration, number two, help you understand the illustration, and then, of course, get you the actual application so you can have something to submit after you meet with your clients. So again, please do make us available for that in order for you to become appointed with this company and receive, in our relationship that we have built here, what would be called street level commission. So you're really coming into this just as if you had become a captive agent to Mass, yet you're going to have that freedom to roam. Second thing is, you need E&O insurance. You'll see that on the side panel of the availability of signing up for our program here at Messer and getting that coverage that you're going to need. Brian, one of the things that I think I'd like you to touch on for the audience is if you could explain what direct recognition means.
Okay, absolutely. So, all right, it's a good question. All right, so I guess I'll answer that question. I'll kind of step to it. So you kind of mentioned there, Mark. So when it comes to whole life, what's interesting about whole life is truly the best whole life products out there are going to be offered by mutual carriers. All right, so not the stock companies, it's the mutual carriers. And the reason for that is because what the mutual carriers are doing is we're gaining profits and we're taking in premiums and we're investing that money and then reallocating out in death benefits and loans and all that stuff. Any of the profits that come in, we're basically giving those profits back to our policyholders in the form of dividends, right? Where if you were looking at a stock company that was trying to offer whole life, they have their shareholders that they have to pay money out to, let alone their policyholders. So the nice thing about a mutual company that makes whole life so attractive is the fact that we're not worried about shareholders because we don't have any. Our shareholders, if there was such a thing, are actually our policyholders. They're the backbone of the company. So in turn, as we have profits, it's going back in the form of dividends. All right, so direct versus non-direct recognition. So one of the great things about MassMutual is when we talk about our whole life policies and having availability to cash, we sincerely mean you have availability to that cash, all right? And what direct or non-direct recognition really comes into play is when you pull loans off the policy, what does that do? So there's two ways of pulling loans. We have either a fixed loan rate or we have an adjustable loan rate. What the fixed loan rate does is it guarantees, if the client were to choose that fixed loan rate, what it does is it guarantees if they ever pull the loan from the policy, that what we're going to do is we're going to give them a reduced dividend. So it's almost like you're pulling money out of the contract. We're going to give you a reduced dividend. So we're still going to give you a dividend, it's just going to be reduced. And then we're going to charge you X amount of dollars or X amount of percent for that loan. So on our fixed loan rate, which is considered direct recognition, what happens is if you pull a loan out, you're guaranteed there's going to be a 10 basis point spread between what the dividend rate is and what the loan rate is. Right? So 10 basis points is pretty minimal, which is nice, but there's still a spread there. All right? When we look at our peer competitors, the next closest competitor, and most of our competitors have direct recognition, their basis point spread is 55%. Or I'm sorry, 55 basis points. All right, so right off the bat, 10 basis point spread versus a 55 basis point spread is a huge difference between the way these policies are going to perform. But when I say that, our competition, that competitive company I'm referring to, isn't available in the brokerage world, so you have to be a career agent to even have access to it. All right? The other side of it, or the flip side of it, is we have what we call non-direct recognition. And what non-direct recognition is we have adjustable loan rates. So right now with MassMutual, we're crediting a dividend of 7.1%. That's our current dividend crediting rate. It is, in all truth, it's the best crediting rate out there in the industry. All right, and I'm not trying to just clout my own products here, but we do all the competitive stuff, and we know right now we're sitting in the best spot as far as dividend crediting goes. We charge so the client receives a 7.1% dividend crediting rate. All right. The way that these adjustable loans work is because we're in a low interest rate environment, we're going to charge them interest on that loan, but we're going to charge them 5%. Currently, as it stands today, we charge 5%. So if you think about it, the client borrows money at 5%, but they're receiving a dividend of 7.1%. There's a positive correlation now on that outstanding loan of 2.1%. So what that means is you can literally pull loans off a policy and actually have growth on that outstanding loan. Okay. Now, an analogy that I try to use, and I think this kind of helps explain it, is let's say you own a house. So you own an investment property. It's worth $100,000. Right? You own it outright, and you have a renter in it. So the renter is giving you $2,000 a month in rent. All right? You need cash for whatever reason. So what you do is you go to the bank and you take an equity line against your house. All right? So you don't take it out of the house. You're taking an equity line against the house. You pull an equity line against the house. They use the house as collateral. They give you a full $100,000 loan. All right? And they're going to give you a payment of, let's say, $1,800 a month to pay back that loan. All right? Well, by taking out that loan, it has absolutely no effect on what the renter is giving you in cash, right? You still have that rental income coming in. So in that example, the client has an outstanding loan. They're able to pay the loan back with the money that's coming in from the rent, but they actually have excess money coming in from the rent, all right? So they actually have a positive correlation there. And that's the way that I kind of help explain what non-direct recognition is, which is the number one way our policies are sold, all right? So in general, and today, now I'm using these numbers and they don't exactly work out to that 2.1% spread, but what you can be aware of is if you pull a loan off a policy after it's accumulated money, you can literally pull that loan out and still receive dividends on that outstanding loan as if no money was pulled out of it and actually have a positive correlation on that outstanding loan amount. Mark, does that kind of help explain what you're asking?
Excellent. Yes, Brian, of course, that was right on time.
Right,
Also,
perfect.
a little basic one, ladies and gentlemen, from earlier in the presentation with Brian was when you're looking at your cash value on a whole life policy, and the opportunity to use that in an emergency, if that policy, as it was stated, can be growing between 2 and 4% on the guaranteed side, those funds that are there in relationship to what someone can do in a savings environment today, I think everyone is well aware you have to really shop just to find 1% anywhere. So again, the value and the safety, most importantly, especially with your clients today, is what whole life insurance is going to bring to the table. One of the questions that came up for us also, Brian, from Paul, is can you talk about a couple of the riders that would come with um, just the basic whole life legacy 100 plan?
Sure. So, all right. So a rider that we see a lot of is our waiver premium rider. All right, and there's a little bit of expense that goes along with it, but it's a rider that more or less says the client becomes disabled, meets our definition of disability. We have a 5-year ONOC disability where they can't do, maybe they could still go back to work and do something at a reduced wage, but they're not able to go back to work for whatever their original income level was. We'll waive the premium. So they can still kind of go back to work, but we got a 5-year ONOC. If they're permanently disabled, we'll pay the premiums for the rest of the life of the contract. So waiver premium is always going to be a big one. We have a terminal illness rider that's part of the product, and that's automatically baked into the contract. And what that is if your client becomes terminally ill, so your doctor basically says you have, less than a year to live, the client has the ability to pull out a portion of their death benefit, income tax free, while they're living, for the fact that we realize we're going to be paying out the whole death benefit in the near future, but we're giving them the benefit of at least being able to have some of that money while they're still living to do whatever they need to do with it. So that's going to be a built-in feature. Some other riders we can do, and some of these riders can sound a little confusing unless we kind of spent more time on them, but we have what we call a term supplemental rider. And what that allows us to do is blend in whole life and term insurance together. And what it really allows us to do is get a death benefit, get a total death benefit that's a little bit lower than 100% whole life, and it's blended in with term and whole life. But as I have paid up additions, instead of those paid up additions pushing the entire death benefit up, which they'll do on their own year after year, is what this will do is those paid up additions will actually convert down that term insurance so that instead of the client having an increasing death benefit from day one, they'll get a death benefit that's level from day one. Right? And what will happen is year after year, the term portion of it will convert out, and at some point we'll hit a crossover point where now the death benefit starts climbing. But it kind of allows us to reduce premiums, again, get them in a larger death benefit if death benefit's a bigger need of theirs, and in turn, and climb from there. From product minimums, and this is just something I feel like I should bring up, is you can sell a whole life policy as low as $25,000, so they don't have to be these huge policies that I was referring to in my presentation. We sell a ton of juvenile policies, which again, if you have clients that have some decent net worth, have kids, want to make sure their kids are taken care of. Extremely inexpensive premiums, but you can put these put these small policies on children. It's just a great savings tool and a great thing to just put in place and lock in their insurability. Those are probably the main riders. There's some other ones that are a little more creative or funky, but I think those would be kind of the more traditional riders we probably look at.
Again, thank you, Brian. One of the agents is asking if we can assist in illustrating the purpose of the whole life for infinite type of banking. And Yvonne, I'd like to address that with you if you'll call back in, and I'll discuss with you how we can assist you there.
All right, let's do that one offline. Yes.
Yeah. Please. And the second one is an agent is wanting to compare, maybe just in a basic, quick answer, what the difference is between using that whole life against a hybrid indexed UL. And again, Dorrance, I think in this case, this is another question we need to address offline. Indexed ULs are not a product that are even offered by MassMutual.
Yeah, and one thing I'll just say about index products I can give a quick answer. So index products, they're gaining popularity out there, but they're also getting a lot of stipulation out there. And what index products are doing is, although they're not invested in the markets, they're going to follow an index. So a lot of times they're going to follow something like an S&P 500. right? And what the argument really becomes is what they're trying to do with those index products is they're trying to make them less expensive than what whole life is. So whole life is this very conservative product that kind of uses fixed investments and fixed assets in our general account. And again, we're able to generate a really decent rate of return off of these fixed assets, but it's a very conservative, non-correlated product. With index products, although they have guarantees on them, they have, you know, floors and caps on them. The thing is you're still correlated to the market. Even though the money's technically not invested in the S&P, right? The money's following the S&P. So you know what? If the S&P starts tanking, you're going to have portfolio balances that are going to have some difficulties within that product. And the challenge is, you know, if they're fine products, they're good products, but they're different products, they're different animals. So they're not a conservative type product like a whole life product is. They're definitely more of an aggressive product. And where I think whole life is going to fit in is that client says, look, you know what, I own equities straight out, so I don't need the training wheels on them like index products are going to do. I don't need the risk of an index carrier maybe pulling my caps down, because we've seen a lot of carriers pull their caps down because they're just realizing they're getting a little too aggressive on some of these returns that they're actually not even generating themselves. So in kind of, instead of being at the mercy of the company, let's go into something that's more conservative and we know it's doing what it's doing. It has a track record to run off of 160 years of history versus something that's got, you know, maybe 10 years worth of a track record, but it's already had some stumbles in that track record.
And Brian, that last point you made, I think, is very important for people to understand. The Index UL product is just barely 10 years old.
Yes. Yeah.
Ladies and gentlemen, we've come to the conclusion of questions. And the last item I'd like to bring to your attention, as always, is the bonus that's going to be available because you took your time this morning to participate, be a part of this presentation. As I mentioned earlier, to obtain a contract with Mass, you've got to bring us an application, number one, but bring us that first application in the next 30 days. We'll get that thing in the system and processed, and within a 60-day period of time, so that you can receive an additional $100 on top of the commission you would have earned. And that's just a little thank you for, again, giving us the time to help you understand better the products that are available. Brian, I can't anything more than say thank you very much. Great webinar that I myself will be reflecting back on to gather additional notes and information. Thank you.
Awesome. Well, good. Well, you guys all take care. So thank you for joining me. Thanks.
All right. Bye.